Yeah, let's get started here. So, let me bring on rod 2 and Palmer. If you want to hop in, feel free, bro. Okay, so options. What are options? So, in layman's terms, or like the most basic thing about options is an option is pretty much gives you a right to buy a stock, okay, or 100 shares of a stock at a certain price. And there's different ways to go about doing that. Okay, so there's options that are in the money, and there are options that are out the money. And options that are in the money, okay, have this thing. It's called an intrinsic value. So they basically have a value to it, which is kind of described by the stock price, okay, its current price minus the strike price. That price, that value that you get is called a premium. So pretty much this premium, okay, is a price that you have to pay to actually execute that contract. Now you pay that price and you can buy 100 shares of that stock at that current strike price, okay? But the thing is, a lot of people, especially options day traders, don't necessarily go about executing those options. What they do is they flip that premium. Now, that premium isn't a set price. It moves. Okay, it can gain value and it can lose value. It's like day trading, but you're kind of leveraging your position and capitalizing on smaller movements in the stock by trading the premium of the option. Okay, now how does that premium itself move? Okay, so that premium price is influenced by a few things. Okay, those are called the option Greeks. Now, option Greeks, there are a few different ones. There's delta, okay, which is what most day traders are trading. Delta is the price your premium is going to shift for every dollar that the stock moves up or down. Okay, so for example, let's say you take an option and the premium costs 50 cents. If it has a delta of 5, for every dollar the stock moves up, your contract is going to make 100%. It's going to gain 50 cents in value. So ultimately, you're trying to trade a premium that has a higher delta, and it's going to pay you harder on smaller movements of the stock, right? Now, there are other factors that influence that premium price movement, okay? And this is more relevant for swings than anything. And that Greek, okay, is called theta. Now, theta is pretty much the price per day that you're paying to hold on to that option, okay? And every day you hold on to them, you have to pay a certain fee, and that comes out of the contract premium. That's how your contracts kind of devalue day by day. Now, if you're holding on to these contracts for a long time, the longer you hold on to them, the more that premium is going to affect the contract. And the less you hold on to them, you're kind of relying more on the delta movement to get paid. So let me invite Nate or yeah, Nate, if you want to go ahead and expand on that a little bit, feel free.
Yeah, man. So I've talked about this in the room a little bit. I mean, options are really great ways to make money, and the Greeks definitely do have an impact. For me, you and I have talked about this a lot. Theta is one of those things that we really got to pay attention to when you're playing things that are much closer to the expiration, right? Especially when a stock is in a period of consolidation. You could get a move up, catch the move, and then sit there for 15 minutes, and your contract's going to lose something like 20%. You know what I mean? But honestly, I think I've told you this. I play these a little bit different when I'm playing contracts, especially weeklies or just scalping them. I actually don't pay a whole lot of attention to the Greeks, and I know I get a lot of crap from that from a lot of different people. But I think a part of that for me is because I'm not holding them a lot, so I'm actually just really playing the IV, and then also that delta there. But if you're swinging contracts, which I know you're probably going to talk about a little bit here, man, those Greeks are incredibly important because if you don't find something that has a good setup for you, like even if the stock moves your way, if you bought something that didn't have good Greeks, like you're going to end up losing money and it's going to be frustrating. So you've got to pay attention to these. But I'll be fully honest, I'm not the expert on these.
Lodge, you want to expand on that?
Yeah, kind of what Nate was saying there. Usually for day traders, the Greeks may or may not be quite as important, overall in the big picture because we're kind of in and out of the trade, right? So we're focused on the price action. There's a lot of breakout traders. There's many ways to kind of go about that. I found that the Greeks do definitely matter when you're hunting. So for people who use options flow services like Whale Stream, Unusual Whales, Black Box Stocks, Tradie Ticks, those kind of things, all of which are great. They all kind of provide a similar service. You can use the Greeks to kind of fine tune to see where some of the bigger money or the whales are kind of targeting, or even just where a lot of people are piling up orders. So that might be the only time where in the day trading world that the Greeks might matter is paying attention to options flow services and finding out where that people are piling up orders. You can use those to find some hidden movement. Erica had a great little piece inside the Discord one day. I think it was either today or yesterday, talking about that, how the delta looked really good and there was orders piling up on a specific stock. I can't remember what it was. I apologize, but yeah, it can be used in that sense. So even as a day trader, even though I'm not particularly interested in Greeks for anything except swing trades, where Nate was talking about, it's very, very important in the swing trades. It's very, very important because it can, if you, like you said, if you position yourself improperly, you'll find yourself not making anywhere near as much money or even losing money where you should have made a lot of money. So very important for the options flow services. Like I said, paying attention to delta is actually very important for some of those. So although overall for day traders, not too important, you shouldn't be going super far out of the money for most of your day trades, although everyone does trade a little differently. But generally, you're not trying to go too far out of the money. You want to stick a little closer towards in the money. And that's why Greeks tend to not quite matter as much, but it's good to know them and great to study up on them, in my opinion.
It's a cool thought. So let me expand a little bit on those Greeks. So as Nate and Audrix were explaining, there's this Greek, okay? That delta, okay? So delta itself isn't stagnant, okay? And what that means is an option can gain delta and you get paid based on its delta. So an option that's in the money generally has a higher delta than an option that's out of the money, okay? And what that means is on a smaller movement, it's going to pay you more easily, okay? Your premium's going to crawl up or down based off what the underlying stock is doing, okay? That in the money contract is going to move more closely to the underlying than a contract that's out of the money. That being said, if you're looking to play a bigger picture move, the out of the money contract is the one to be taking because it's going to pay you bigger, okay, as it gains delta when it's moving closer to in the money, okay? Now, there's a few factors that influence whether your contract is going to pay you or not. Okay, and one of those biggest factors, besides time, which is theta, okay, is implied volatility. Implied volatility is like a super important concept to consider when you're trading any type of contract. So, how the implied volatility generally works, okay? So, when you're looking for a contract, you want to be buying something that's low implied volatility. Okay, why? So, like one of the first things that I mentioned is that contracts have an intrinsic and an extrinsic value. Contracts that are out of the money don't have an intrinsic value, they only have an extrinsic value, which is implied volatility and time or theta. Okay, that's the only value that out of the money contracts actually have, right? So, now let's consider IV. Let's say you take a stock that has low IV or an option with low IV. If this stock gains value or loses value really quickly, okay, on bigger movement, it's actually going to gain IV, okay? And because it's gaining IV, guess what? It's adding extrinsic value to those contracts, okay? That's how you have contracts that move, not so much, that get an IV spike. Those premiums will move up with you because you're adding extrinsic value to those contracts, okay? Now, the latter, let's say you're trading a stock today, that ran up 100% on the day, and you're saying, oh, I think it's going to go down from here. Let me buy some puts to capitalize on the downward movement. Guess what? Those puts, okay, playing the downside isn't going to pay you as much as playing the upside. Why? Because the IV on those contracts have already been gained. Now those contracts, that were once at maybe 70%, 80% implied volatility are now trading at 200, 300% implied volatility. So even as the stock is moving down, your contract premium isn't uh, isn't going to be gaining value too much. Okay, so that's why it's higher risk trying to place something with high implied volatility compared to something that has low implied volatility. Ace, want to add on that?
Yo, I'm just in the background munching Popeyes. I just got home.
Oh my god, this guy.
I think one thing that I will add for out of the money contracts is when you do play those, make sure you decrease your size quite a bit, just because of the fact that they are a lot cheaper. So, like every cent move is going to knock off potentially like 10 to 20% of your contract's value. And if you're adding size behind that, like that's a massive loss. Um, so I think like a good way to kind of go about it is play slightly out of the money. I usually play like the next one over, and if I'm going further out because of the range of the stock, I'll decrease my size heavily and put some smaller size behind further out of the money contracts.
Yeah, I kind of to touch on what Ace was saying. I also agree with that. The good rule of thumb that a lot of people, a lot of much better traders than I am, have mentioned is that generally speaking, you don't want to, and obviously it depends on the stock. So it's a pretty broad stroke statement, but generally speaking, you don't want to go more than about 2 to 3 strikes out of the money. It tends to get a little crazy, and this is where we were talking about the IV, and the Greeks might be able to help you narrow down the two things that I'll note before I leave here and leave it up to you with the goats in the room is I tend to pay attention to two really big indicators. I use this also while hunting for flow, especially on unusual whales and whale stream. Is I tend to focus on open interest and volume on the contracts. It tends to really help me see where a lot of people are stacking up on what contract. So sometimes you'll find a contract that's about 4 or 5 strikes out of the money, and if you look at the setup on the chart and you think there's a lot of range for this to really move, there's a lot of bullish flow, if you're looking for calls, or bearish flow if you're looking for puts, and there's a lot of range, and you see a lot of whales or even just a lot of regular retail piling up on a specific strike that's maybe 1 or 2 contracts further out than you're normally, that's usually a somewhat safer bet to grab those. It's again, it's one of those things where you just kind of have to learn how each stock is. That's a personality of the stock thing. It's very important, but it can help you narrow down a lot of maybe not quite as high quality positions that are further out of the money.
Another thing I'll add on to that is I don't know if you guys follow All Day Faders, but he does a lot of data tracking, and something that he's pointed out a lot before is his Thursday Friday rule, where you'll see contract with sort of the highest OI tend to be closed to the opposite side of, just to crush those, like call or put collectors. Um, it's sort of just a way for them to collect pre-premium by expiring out of the money contracts. And that's sort of just one thing to watch for when you are trading contracts, to look for stuff that stuff that typically has higher OI than other ones. That's usually where their targeting price closes.
Agreed. Gentlemen, ladies, gentlemen, I leave you all in very capable hands. I bid you all a very fond farewell and have a fantastic evening. Please stay safe tomorrow. Stay green.
See you, Lodge.
Later, Lodge. Take care.
Yeah, so adding on to that open interest and the volume statement, it's actually super important. So it's actually more relative, in my opinion, to small caps compared to large caps, and for one main reason, okay, and that's liquidity. So let's say you buy a contract that has no volume, okay, and you buy a bunch of it. You actually won't be able to get rid of those contracts even if the premium moves up on you, because there's no buyers, so it's kind of irrelevant compared to larger caps, because you generally have always volume and open interest on contracts, and you'll pretty much be liquid every single time. But when you're trading options on those small caps, guess what? That's not always going to be the case. So you always want to pay attention to that volume and open interest, to see if you're actually able to get rid of those contracts if you make money on the premium. I see MG's hand raised. Let's see what he has to say.
Hey guys, thanks for including me. Thanks, Dr. Bullshark. This is a great space, by the way. I just want to kind of chime in there. Like, I think for most retail traders, I mean, I traded derivatives for many years institutionally. I'm kind of in semi-retirement right now, so I'm doing a lot of it in my own portfolio. I actually do about half and half buy and sell options. So I take in a lot of premium, and I also kind of punt on options. I almost never do arbitrage activities, which is what most people do in the market making world, which is like, that's where the deltas and the vegas and all that stuff makes a lot of sense. But from our perspective, from the perspective of the retail guy, I typically find that, like the previous, kind of guys have said, if you find a few things slightly out of the money, up to 2 or 3 strikes out of the money, that's usually like the sweet spot for a directional play, whether it's long or short, whether you're buying a call or buying a put. I think that works out pretty well. I typically like to do longer swings, so I'm actually okay with 3 to 6 month type holds, precisely because there's very little theta decay. So, in the weeklies, I know that weeklies are really popular in Twitter space, but the theta is just vicious on weeklies, especially if the implied vol is really high. I personally don't like to buy anything with an implied vol higher than 60, 65. I typically sell a lot of options, when the implied vol is that high. But if your implied vol is 60, 65, the theta decay is vicious, especially when you get to like 1 date or 0 date kind of stuff. It's just totally vicious. But if you have like a view and you think that view can pan out and you're going to give yourself, say, a month or 2 months, the rule of thumb that I like to kind of use is pick whatever horizon you think your view is going to realize itself, and then double that time in terms of like what you want in terms of option expiry. And almost always that works out really well, and you're not sitting there sweating it and being right. So for example, let's say you buy a 70 strike call and the stock might be at like in the low 60s, and you buy it for $5-6, and lo and behold, you're right, and it goes from like the low 60s all the way to like 74. But if you waited a month and you lost all that theta, you might find yourself losing money in that situation. And so you don't want that, because you were right, but then you lost money on how you traded. So those are just some of the tips that I could kind of throw in there. I hope that was helpful.
Yeah, that was
I think
awesome.
I think a good lesson that I learned about Theta was one time I was swinging a contract that I had entered in on a dip early in the morning, and then I had also day traded them, so I was able to see a monthly contract side by side with a weekly contract. That really gives you a good idea on how theta decay really comes into play on a ticker you're trading. So I recommend anyone who's new to options, when you initially start, start with something further out because it's going to be less volatile, and also start with something like a weekly contract so you can see them side by side in the same play.
I totally agree with that. The one thing I'll add to that is that if you notice, the implied vols actually shrink after around 11 o'clock. And so from 11 o'clock to like power hour, the implied vol is a lot lower. So if you are going to buy, I find this is kind of a crazy rule of thumb, that's when you can kind of buy things cheaply. If you kind of come in the open and just buy, market makers know that like people are looking to essentially buy puts and calls. And so the implied vols get jacked up around that time.
Yes, Q, I know you're on here. I know you've been doing quite great yourself. Do you trade options?
So hi guys. I've talked about this before, but I'm just here as a listener today because I trade options, but not as frequently as some of you guys do. I'm not well versed enough to, talk about them or say like what I'm doing other than I've talked about this before. I scalp basically off news. So that's where I trade options the most, and I'm usually scalping right at the money, in the money contracts, either puts or calls off news. But that market hasn't been here for a while for me, so
just a quick
I
thing I'm
haven't
going
been doing
to
that.
add to her thing about the news plays. If you're not first to those news plays, don't hit the contracts right away because the IV jacks up so fast. I think it was like Workhorse was one in small cap land
Yeah, we
last
were
week
watching that.
where they had the SEC news come out for it, and the contract spiked up to like 300% IV right away. So if you miss that initial move, don't chase it, because obviously when that IV comes back down, your contract is going to lose value. If you can get in on the dead cap bounce for a quick scalp, I think that's a better way to go about it if you miss the initial move, but it's never worth chasing.
Well, and the same thing goes for any kind of a breakout. Like if you're a breakout trader, typically something will break out, price might spike up 50%, but then it comes back down to your entry. So never chase any of that stuff, because then, right off the bat, you're holding a 20% bag.
So yeah, I mean, besides the bag holding fact, it's like the same thing as trading commons. There's always going to be a retest of that breakout. And that's usually the best time to pick it up. Or if you do, take a starter, and when it does retest, that's where you really want to kind of take your position, keep your stops under it. That way, you're kind of mitigating your risk, like while you're day trading those options. So yeah, that's kind of technically what I do. So how I pick my strikes when I'm trading these options is, I was telling Rhodes and Ace about this a while ago. How I like doing is I like taking one in the money and one out of the money contract. And, as let's say you're playing calls, as the stock is moving up, you're scaling out of your in the money contracts, okay? And, you're waiting for your out the money contracts to move in the money. And as it's going up, instead of buying more of one contract, it's better to pick up the next strike out, because you're trying to make money on the delta. As I was saying, that delta is being added to it, right? So as you're taking the next strike out, you're capitalizing harder on that delta movement instead of trying to make more money on that one contract itself.
Yeah, that's something huge that you taught me. So, full transparency, the way I learned options was I stuck to what I knew. So, I started with day trading them, and I realized that I could successfully trade them based on what had the highest volume for intraday trades. But I quickly realized from Bullshark that getting paid on Delta is 10 times better. They're going to be more expensive. I mean, it's not really about the price of the contracts, but it's definitely the better move to get paid on Delta, and as opposed to getting paid on like percent change.
Yeah, that delta payment is ultimately what you're really trying to capitalize on if you're trading these day trading these option premiums. So sometimes you'll see an option and, the contract premium is super expensive. But how I think about it is kind of, if it's more expensive, you're paying for the safety of this movement. The cheaper they are, the less likely you are to profit on them. Yes, if it does go your way, you're going to profit nice on them, but you're also taking that risk factor on bigger, so and it's the same thing, with your like contract expiries. So you're gonna get paid pretty much the same as if you go heavy on a further expiry, and if you're going light on like a weekly, for example, because the weekly is gonna pay you more on that movement, but in reality, the further expiry is safer, and you can size up on them, and you'll stress less, because now if you need to, you can swing them. Not saying you should, but you can swing them if you want to, and you're gonna get paid the same if you're sizing up heavy on the further expiry as if you're taking light on like the closer expiry. So, and it's the same thing with the in the money versus out the money scenario. Like, if you're trading in the money, the contracts are gonna be more expensive, but you're more likely to profit on them, especially if you're already planning this movement, this upward or downward movement, and it's just easier to capitalize on them. So, how the right way to do it is, instead of loading up on just one strike, take multiple strikes. Put a little on some in the money, put a little on some out the money, and then take your lottos on further out the money, just in case it does make a big movement. Then those out the monies that you're light on are going to pay you heavy regardless.
I love that strategy, but Bullshark, do you have like a rule of thumb that you use? Like, for example, let's say you use something that's like 10-15% in the money. Obviously, you're going to want to take profits at like shorter or at smaller returns. So
Exactly.
you want to you're going to want to take a 10% profit, 15% profit, et cetera. But if it's out of the money, like you're going to want to wait until it's 50% profit. Is that how you look at
Yeah,
it?
exactly. So my general rule of thumb is if I'm scalping, I'm going for the in the monies because they're gonna be paying me harder, with delta on those smaller movements. But if I'm going for like, a big intraday movement, you can take further out the money and get paid better on them. And yeah, so that's kind of what I look for when I'm trying to determine my risk factor.
And how do you balance choosing that versus like, do you look at like how wide the bid ask spreads are? Or do you kind of just lift the asks when you're scalping, or do you kind of try to like, lob something in the middle? How do you do that?
So that's a good question. The bid ask is somewhere where people really get messed up on. So how I personally like doing it is I always take my starter at the ask because that way I'm just gonna get filled. I don't even want to stress about like a couple cents for me to be able to get my fill or not. So I'll take a starter at the ask, and I'll put some orders at bid and below just in case it does do that retest. Then I'm getting more contracts at those cheaper prices and really like scaling into those options. So yeah, I like taking the ask and putting my orders at bid and below just so I can get my full size, and then I'll get in.
Yeah, that's something I learned with large caps is, you got a lot of these familiar companies that you might know just from, you know, being around. But you can't really trade them all. Like my watch list is a specific group of tickers that I can trade every day that typically have high option volume as well as tight spreads. So I don't typically ever have to worry about those, whether it's in the money, at the money, or out of the money. There are scenarios where those spreads do widen, but it's just something you have to be consciously aware of before taking a trade.
Just another note on sort of the volume side of things. If you are scalping options, at least for myself, I like to look for the contracts that do have quite a bit of volume because that's where you're going to have sort of the FOMO chasers and market slappers. If you're playing the low volume contracts, most of the trading is on the algo side. So when you are trying to, like get out of the trade, you're essentially being forced to sell onto the bid unless like you get a really big move in your direction and your ask gets taken out. But most of the time you won't get that if you're scalping. So look for sort of those higher volume ones where you're going to have those FOMO chasers and market slapping so you can get filled on the ask side of things. That's kind of one way to take advantage of the spread.
Yeah, it's the same thing kind of when you're trying to sell them too. So how I like doing is when I take my position, like you kind of know where these contracts are gonna go, and if you don't know, you can use like an options profit calculator to see at what price your premium is gonna be at. But yeah, once you take your position, put your sell orders, and put them at increments. So just in case you do get crazy wicks like that where it does pop or it does drop, you'll be able to get rid of some of your contracts at that big range without having to sit there and trying to fill your orders. It's just you're being preemptive on it, and it's gonna increase your success rate for sure.
That's like 1,000%. I can't stress that enough. Always have fishing bid and fishing sells on both sides. Like there's always these random spikes from time to time in large caps, whether like news or some random occurrence, and oftentimes on those wicks you can get filled for crazy prices.
So I remember being in GMT, you and Bullshark, Ace, you and Bullshark were teaching that. I just want to say for anyone listening though, that is a good strategy. It's not something you have to definitely implement. Um, like for me, I rarely do I see the contract. One thing I want to note before that is when I'm trading, I typically won't look at the option contract at all. I just use the buy and sell buttons. Um, but I don't know. The setups I trade typically don't have scenarios where you have fishing bids on either side. I don't know if that's because I typically trade the tighter spreads. You will have spikes in large caps like that too, but that's not necessarily a strategy I'm planning on banking on every day.
Yeah, that
Although
that
it could work.
strategy is more so like relevant, especially for like news plays. So like, let's say like a good news drops or a bad news drops, you do like you'll see those spikes happening a lot more often than you would believe, bro. Like, for example, I remember trading GM. GM popped for 2 candles, and I played it off the first candle, and I put my sells, like way up there just in case you do get a second spike. And it did do the second spike, and it just completely dropped after. So I was able to get rid of majority of my contracts at that, that fishing sell.
I remember that.
So it does come in handy. It's not necessarily a strategy that you have to bank on. It's not more so for playing those bigger movements. I would say it's more so for getting in and out really quick for scalps off news plays specifically.
Of course, yeah, and I typically don't hold that many positions. I know you talked about holding a few positions at a time, but I typically will have my buy and sell buttons ready for anything that I'm day trading and or swing trading. But that's definitely something that's worth talking about too. Those spikes. I mean, you guys kind of touched up on it, but spikes in large caps like equate to what a halt would be in small caps. The way I see it is you're making more money in a short amount of time, right? It's going higher than you anticipated. I don't think anyone really expects a spike to be part of their plan. So when you do see that in large caps, I typically do like to sell out. For swings, I'll still let the higher time frame work out. You could choose to sell, but I've seen a consistency that when you do get spikes, they do like to come back down. Whether it's really good news like you saw on AMD the other day, where it continues to go forward, it's still best to capitalize on that IV spike and the spike on the underlying and sell out and then get back in.
One of the best times that I found to do those fish and bids and fish and sells is actually in like the first 30 seconds to 2 minutes of market opening, specifically on large caps. When you see a flush, I'll often set just a low bid for somebody who gets panicked and just market sells, and typically I'll get filled, and I can do it on the other side too for somebody who market buys when it turns around. It's a strategy that you've got to be really careful with because, at the same time it can work against you. But, there are certain times where it's actually one of the best to use, in my opinion.
Just touching up on what Rhodes mentioned earlier about not looking at the contract chart. I do agree with that in some senses where, like a lot of times what you'll have on your underlying ticker is the stock's pushing up and one candle retracement knocks off a hefty percent off of your contract. So actually on that note, like another thing to keep in mind is to scale out into strength, just because like often that pullback can retrace your contract to the origin. But the other thing there is look for a reason to sell. Rhodes preaches this a lot where if a contract sort of has, or if a stock has open range to the next resistance, don't be rushing to sort of get out just because your contract is up a few percent or whatever, right? Look for a reason to sell, let the play work out. And I think that's pretty much how you can bank sort of the hardest off of those larger movements and stay in your plays as opposed to, like selling every 10-20% pop, and then your risk is also about the same too, right?
Yeah, and then one more thing I was doing when I started to learn options. So I mentioned earlier that it's a good idea to take a trade and compare like a weekly chart to a monthly chart. You don't necessarily have to take a trade to understand the movement, right? What you could do at night is for any ticker that for an underlying setup that you might have traded today on like Apple or any large cap, you can go compare the weekly chart to the monthly chart. Typically speaking, the in the money or the closer in the money options will be more aligned to the underlying. Whereas when you get out of the money, obviously those are going to be ones where support and resistance won't really work. That's something I learned too, especially when trading out of the money options. Is you can't base technical levels off of those contracts. And then even as you go closer in the money, that still holds true. They're going to align more with the underlying, but they're definitely not going to be, a direct replica of that. So that's why typically for me, I don't look at the option contract when trading. It kind of acts like the 1 minute time frame, which I don't trade on unless it's earlier in the morning. But it's kind of designed to scare me out at times. I really just like to focus on the underlying price action. Sometimes that results in a situation where I might be taking a larger loss, but I am also a bigger picture trader, so I do expect bigger moves. So it kind of counterbalances by not looking at the option contract. Or sometimes, I'm always going to be mindful of my risk. I do like to keep a a close 10-15%, even for option contracts. A lot of people don't think that that's necessarily attainable, but it all comes down to what contracts you're taking, right? So I say, if you're trading a breakout and it's, fumbling around that breakout level, but it hasn't necessarily failed that breakout. If you're taking weeklies, especially after Wednesday, you're gonna get a lot of volatility in that. How do you keep yourself from missing out on the big move that's still gonna be working out on the underlying? You take something further out, right? So just know your personality. Know that sometimes your personality or your confidence in a setup could be okay. I'm going to hold through this, but sometimes your personality is, you're good at, or you're not so good at holding through volatility. So that's when you can go take a next week contract or a monthly contract to help you stay in the position. That's my big thing, and what I've seen with a lot of the new option traders. And I'm not a veteran by any means, but they're in these good trades, but they're choosing a contract with such high volatility. For me, like what Bullshark said earlier, I'm putting size in something that isn't as volatile. So it's going to remedy the problem of not having as high as a percent change as maybe a weekly contract, but it'll still equate to the, putting more size into
Well
something less
fucking
volatile.
said, brother. Well fucking said.
Yeah.
That was well said.
So,
Yo, can you guys hear me?
yeah, what's up, Shinobi? Welcome, bro.
Yo,
Hello,
dude,
hello.
I'm at a fucking restaurant right now. I asked them to put me outside so I could talk. I'm like, fuck, I forgot about. Oh, dude, when you posted it, you said 1.11. I thought that meant 11:11 at night.
No, 11:11 in the afternoon, PM.
I went back and you said PST market close. I'm like, oh fuck.
I literally had to do the conversion too to double check for my time.
I'm the only one trading California time.
That shit was more confusing than options.
Oh my god. But yeah, so I want to talk about a Greek right now that's super underlooked. A lot of people don't necessarily look at this, but I feel like it's super important to mention. And that Greek is Vega. Okay.
Yes,
So,
I love that.
So Vega it's a super important concept that all options traders should consider, especially because it has a direct correlation with implied volatility. So as you guys know, when you're buying something with low implied volatility and the implied volatility jumps, it's going to add that extrinsic value and make your contract premium gain value. But now think of it this way. Options that are super out of the money or super in the money are going to have a bigger implied volatility shift on those movements, right? But there's another factor that influences the premium gain that your contracts are going to have, okay, for those implied volatility movements. And that Greek, okay, is Vega. Now, Vega, okay, basically means how your contract, okay, or which contract is going to be more reactive, okay, to implied volatility shifts. And the general rule of thumb to think about for Vega is a contract that's closest to at the money, okay, whether it's one in the money or one out the money or two in the money, two out the money, are going to have the best Vega. What that means is, even though the implied volatility on those contracts is going to move less than the ones that are super out the money or super in the money, they're going to be more reactive to it than the latter, right? So that's specifically why I always play, one in or one out the money, just because the Vega, okay, is primed specifically for those contracts. So even though it gets a small implied volatility shift compared to the other ones, it's going to actually gain more of that extrinsic value compared to the other strikes out. So that's a super important thing to always note when you're, an implied volatility type trader. I don't know where Shinobi went. I wanted him to add on that, but Nate, do you ever consider Vega? I know you don't really trade the Greeks, but
No, I do. I mean, I'll look at it for some of the longer things that I'm doing, but I'll look at all of them. But for the short ones, like I said at the beginning, I'm mainly looking at the implied volatility. I do want to know what Theta is doing if I plan to hold it over, a couple hours, and then the open interest and the volume. Outside of that, for quick scalps, I'm not looking at it. I do think it is really important. I just haven't built my strategy around any of the Greeks, but some do, and some are incredibly successful doing it.
I do have some thoughts on Vega, if that's okay.
yeah, go ahead, bro.
Yeah, man. first of all, I think it's great that you're bringing that up. My experience has been that when you're doing swing trades, say trades that are like 2 weeks to kind of 3 months type situations, that's when Vega makes a huge difference. And the times when Vega can really bite you hard is through earnings dates. So if you are holding through an earnings date, a lot of times if you notice, like, if you look at the sort of the implied volatility of options. So like, let's say the earnings is like, December 15th. And so you look at the December 17th monthlies, the volatility could be like 70, 80%. Then you look at the Januaries and it's like 60%. And then, as you go out to like February, it's like, 50%, 40%, whatever it is. And the reason is because like people are anticipating a huge move right at earnings. And so if you hold through that with a high Vega option, you are going to get a massive crunch afterwards. So
Fact.
hopefully you got the move that you wanted, or you're just going to get crushed. So that's when I think Vega is really important, is if you're holding stuff through earnings.
Yeah, so Vega is like a super important Greek if you're trying to capitalize on those, not just those longer term movements, but longer term contracts on shorter term movements. I feel like that's what you were trying to explain, right, MG?
That's a great way of saying it. That's exactly right. I mean, if you hold like a 6 month or 1 year option, if you hold leaps, and the implied vol is 45%, and like you said, you're right on the stock moves up like 10%. If implied vol goes from 45 to 35%, you got hosed on your investment, even though you were right on the delta.
Yep.
A thing I do want to add there on the topic of earnings is someone was asking me earlier in my mentorship how, like, when you're kind of overpaying for an option contract. And I think the two kind of ways to gauge that is one, the IV, or that's pretty much around IV. The thing I wanted to mention though was like during earning weeks, a lot of times you'll see the IV start to jack up quite a bit. So if you're looking to, open swing positions and stuff, maybe take a step back and wait for a bit for the IV to cool down before you enter, and then, like just lose value off of that.
You guys look at Rollo? MG?
What's Rollo? Can you tell me? I don't know exactly what that is.
Isn't that the last Greek?
Row?
Row.
Oh,
Yeah.
row.
Did you just say Rollo, bro? No, bro.
I was thinking of.
I thought this guy was talking about the ticker.
Cleveland show.
Bro, Cleveland show, bro? Rollo?
Oh my.
Row is something that people looked at back in the day. Like when I first started, interest rates, we're like at 6.5%, 7%. So, that made a difference. But like, interest rates have been pretty much close to zero. So for most practical purposes, you can completely ignore row.
I would have to agree with that. I don't really look at row either.
All right, thank you. I didn't know if it was more applicable in longer term holds, because that seems to be your.
You're right.
have a
In a
question
normal
for you
interest
on,
rate environment, you're totally right. But right now, if you look at the curve, the 10 years like at 150, 155, it's not really that relevant.
Okay.
I have a question for you on sort of like your institutional background a bit. So when you guys are trading, what kind of like, time frames or indicators or not necessarily strategies? I think that's a bit like NDA stuff, but what are you guys kind of focusing on? Is it more on the fundamental side, any technicals or anything?
Well, I did a lot of convertible arbitrage, and I did, so that's largely taking a bet on credit and really literally taking a bet on the volatility of a stock. So if you're buying, these are options that are like 4 or 5 years out. So if you're buying a tech company and the 4 or 5 year option is at 30%, and you're like, you know what, this thing's going to be much more volatile than that over the, let's say next year that I have to hold this. That's where you kind of buy. You buy in the hope that there's just a lot more movement than is sort of priced in through the option. That's how a lot of people, who trade longer term options trade. But in the short term, like, the way I've been thinking about it is, and a lot of institutional folks do this is, markets roughly are consolidating about 70 to 75% of the time, and then they're sort of trending And I know that those are difficult to identify, but like, roughly that's sort of true. Most traders that I've spoken to agree with that. So most of the time, most markets are just consolidating. And then like, about 25% of the time, a third of the time, they're trending. And so for that reason, I've made most of my career selling options because, while it's consolidating, I just it's like selling insurance. I just get money. But, recently I've been trying to kind of get involved in sort of the trending world. And, folks have gotten some pretty advanced strategies these days as to sort of like how to take advantage of situations when there is a breakout
Yes,
or when
sir.
there's momentum. And that's largely, I think, why retail is so interested in it, because it's a levered, high octane way to make a lot of money if you're betting on a trend. Did that sort of answer your question, or were you looking for a different line of inquiry?
I think that's pretty good for, I guess, like on the topic of time frames and stuff. Is there any you guys give preference to, or even like on the indicator side, like moving averages, RSI, or any of that stuff?
A lot of the guys that do like serious quantitative stuff, they don't look at much of those kind of technical indicators. They have a lot of statistical indicators that they use. Like, for example, what they'll do is they'll say, okay, like, Ford and GM are sort of correlated. One sort of lags the other. If one is moving, but GM's not moving, well, within like a few hours, GM's going to start moving, or a few days, GM's going to start moving. And so those are the kinds of, that's the kind of time frame that they look at. A lot of like the really quantitative guys, you look at Renaissance, you look at Citadel, whatever, their time frame is within a day to like say a week. And they're looking to sort of get in and get out and turn over the book many times. There are people who do more fundamental stuff that look at much longer horizons, call it 3 months to like, multiple years. But the guys that are like, trading massive volume tend to look at much shorter horizons.
Gotcha. Awesome. Thanks.
Yeah, and I kind of play both worlds, to be honest. So how I make my money is so just generally background speaking. I started trading a couple years ago, maybe 2-3 years ago now, and I started an account with around 25,000, and I was blowing up my account. I know a lot of people don't do that. I know Rhodes hasn't ever blown up an account, but I took my account from 25K to 5K, and one of the problems that I had specifically was swinging these options in a short term, hoping for a bigger payout in the smaller term, in the shorter time range, and some of them would pay, but the ones that would miss would chunk me harder than what I was getting paid out. So how I decided to kind of up my game from there was, not just necessarily sizing up on like a shorter term contract, but instead how I, kind of advanced from that point was I was trading, or I still am trading, these like weekly or bi-weekly contracts. Okay. And then I'm taking the money that I'm making from them and putting them on, for the larger term swings, So for example, let's say you're playing Boeing and you're expecting like, the weekly breakout. Okay. You can trade the intraday movements. You can trade, the weekly option today and make some money on the premium over there, flipping it, and then you can use that money that you made to go fund your longer term swing, right? That way your risk is kind of being mitigated because you already made the money trading your shorter term contract, right, and capitalizing on that movement sooner, and you're using your profits to kind of roll over your contracts. So again, like, you can take just the longer term contract straight up, but if you're doing that, you want to be scaling in and scaling out as you're getting your movement. You want to be taking some money off the table and revisiting them, when the time is right. So instead, I just take both contracts. I take the shorter term and the longer term, and I scale them out accordingly.
I think that's a great strategy, and that's the kind. I would love to hear what other people do in order to like capture larger trends. The way they do it, the sort of quote unquote, this is horrible, but the naive way to do it is to just buy like a longer term option and just kind of hold it until the trend kind of like is realized. But Bullshark just kind of outlined a different type of strategy where it seems to have better characteristics. I'm just curious to see if other people do stuff, more sophisticated stuff like that. That's really cool.
I don't swing. I don't think Rhodes does a whole lot of swinging either, so we don't really have many complex strategies in that corner.
Oh no,
I
Rhodes
make I make most of my money swinging, yeah, but nothing
For options?
Yeah, nothing complex though.
Oh, I thought you were doing more day trading.
I do both.
I just do day trading.
But do you guys do like roll-ups and stuff like that? Like if you're riding something up, do you do something more sophisticated on that level, or you just stay with weeklies when you're rolling up?
Oh yeah, if it's a larger scale breakout, at that point you want to be doing roll-ups. I don't think I've captured a breakout of that scale yet where I've had to do it, but I do know a lot of sort of the more prominent traders like Theta Warrior, Ripster and stuff. They'll roll over into the next kind of further up contract.
that's what I do, bro.
Yeah, that's what Bullshark taught me. Roll them over, or like he was saying earlier, double it on the contract further out.
Yeah,
and it'll pay the same. But it all comes down to your confidence in the breakout or your timing when you believe it's going to actually make its move.
Apollo, you want to add to that? Go ahead, brother.
I didn't necessarily want to add to that. I just have a question about wash sell rules when you're doing options, because I'm kind of new to trading stocks. I've been in it for a year. I've made some big gains on some plays, and I've also lost some on the same play. So I was wondering how the wash sell rule plays in taxes.
You want to expand on that a little bit?
Oh, no, I was just asking because I'm new to it. I don't know what happens come tax season. Like the gains that I made from those huge gains, and then I lost, like, well, I'll still get taxed on the gains, and the losses don't count, correct?
I don't know. I feel like you should speak to your tax advisor.
Yeah, that's what the tax advisor's for.
We just
I
play the
didn't
chart.
know because you guys have been through tax season with stocks. I didn't know if you guys had any like outlook on all that.
Yeah, I'll be honest with you. I just get my my form and I just give it to my tax guy and say, "Here, deal with this. Give me my money."
Yeah, even then.
I'll
even
throw
then
in a
we
couple of
shouldn't advise.
comments with regards to taxes, because I've been I've been pissed about paying taxes. So, if you're not in, like, there's some people who are designated traders, and so whatever the P&L goes through their accounts basically counts as trading income, and it's like a certain portion of it is just long term, a certain portion of it is short term, so that they don't have to kind of write basis and when they sold and all this stuff. They don't have to keep track of all of that. But if you're not doing that, the wash sale rule, as I understand it for stocks, is usually like if you sell something and then you buy it back again, that's where, like, if you have gains or things like that, that gain is sort of wiped out if you don't wait 30 days before you buy something again. If you're trading a whole bunch of options, the tax rules typically count options as completely different securities. So if you're buying and selling different kind of strikes, as long as you're not buying the same strike and the same option, that shouldn't trigger the wash sale rule. Having said that, another issue with the taxes, actually a benefit with the taxes, is that if you own something for a long time, like if you own stock and you're a little bit nervous about it and it's long term, let's say, or it's close to long term, like let's say you got like 2 months left before it's going to be 1 year. If you sell a call that's out of the money and it's a covered call because you own the stock, whatever money you make from that call doesn't actually trigger a sale for the purposes of owning your stock. And so that's kind of a neat way where if shit goes down and whatever you collect from your from selling the premium, you're going to keep it, but at the same time you haven't changed your basis on the stock. So I know a lot of people use that as a way to kind of quote unquote age their position if it's really close to the 1 year mark.
So let's say somebody made like 80K on their account. They started with 5K, they made 80K, and then they lost it all. Does all their gains get taxed if they did wash sell?
I hope
or
this
do you
isn't
guys
you,
even
Apollo,
know?
bro. I hope that's not you, man.
Dude, it is me. It's a very
Fuck.
humbling experience that's happened. I started
Whenever
with
someone says, so let's say, it's about them.
Okay, so let me tell you the story. I started with
Yeah,
5K
just to interrupt
last
real
year.
quick, I gotta get going. This was really awesome. Thanks for hosting this, Bullshark.
It's much love,
Take
bro.
care, everyone.
Thanks for coming.
See you guys.
Bye.
So last year I started with 5K and I made it up to 70K. Then I dropped down to 25 and transformed that into 90K. And then I just lost it all because I've never been a part of a bear market, which was in September. That month just rocked me bad. And then I was being real emotional. And yeah, so I don't know if I'm going to be screwed on taxes paying all these huge gains that I made, even though I lost it all.
No, I think you should be fine, bro, to be honest with you.
Okay,
First of
that's a
all, I
relief.
feel you, man. That's a rough ride, but you know what? What doesn't kill you makes you stronger. So onward and upward. But as long as you're not trading the exact same stock over and over again, you should be okay. It's when you sell something and then you buy the same thing over, and if you sold at a profit, that's when that's when your profit is sort of like, kind of hits the wash sale roll.
I think that's the boat he's in. But good luck, Apollo.
Thank you. Yeah,
Yeah.
I'm kind of in that boat. Like, I made, I think it was like 15K off BBIG, and then I sold and then bought a bigger position and lost it all. I don't know. I might be screwed.
Yeah, I mean,
I don't know how all
it'll
of
be
it
a
works.
learning experience for sure, but just make sure you straighten it out.
I appreciate you guys.
One thing I guess I wanted to talk about, we kind of talked about it earlier, but I just wanted to stress it one more time before I have to head out too. Um, but anyone who's learning options, who might be listening into this and trading them tomorrow, like I said, test the waters, go study them tonight, go study the contract charts, specifically at like support levels, right? So what I meant by that earlier is if you see a support level on the underlying, go compare what a weekly chart would have looked like, and keep in mind that it is Thursday, so it's going to be a little bit more volatile. Go look at like what go put it into like a percent change calculator and take like the high point and the low point and compare that percent change. Then go take the next week's and then go take the monthlies. That'll really help you see how they work out. Do that for support, do that for resistance breaks as well. Also, I know monthlies you typically associate with swing trading, but as we've said, they do pay. I mean, and they keep you in the trade longer. I recommend anyone who's trading the open, which is something I do, if you're not comfortable with um, weekly contracts, you got to keep in mind the open's always going to be volatile. Some days you get the days where it's straight red, sometimes it's straight green. But for the most part, if you get in on one raw candle on a weekly, you can be down super fast. To prevent that and to stay in the trade, to stick to that higher time frame thesis, your monthly is going to be your best friend, even something further out. But for a day trade, you can do what Bullshark does too. Take two contracts, right? Capitalize on the weekly and then stay in the trade for the monthly, right? Through those dips, through that open volatility.
Smart man. I wonder where you learned that, bro.
Yeah, I learned. Shout out Erica. Shout out Dr. Bullshark. They taught me everything I know for options.
I love you, man.
Thank you guys. I do have to head out though, Bullshark. Thank you.
Yeah, bro.
Thank you, everyone else who was on here. Have a great night.
Love you. Peace.
I love you.
I have another question for the panel. Does anyone here actively trade options on ETFs, or do you guys just trade options on single stocks?
I'm a big ETF trader. QQQ and SPY is like my go-to for day trading, just because it follows technicals so damn well, and also these ETFs have 0 days till expiration contracts 3 times a week, so it's really easy to capitalize gains on smaller movements real quick.
Yeah, those look like super enticing, and even some of the sector spider ones, I think that they're like a great way to kind of just ride a particular trend, without all the crazy volatility.
Yeah, so I kind of have a certain rule when I'm trading those. So how I like doing it is, if I'm trading those 0 days till expiration contracts, they're gonna have insane delta. Like small movements are just gonna pay you like crazy. That's how I'm able to pull off, like minimum, 200 to like even last week I pulled off a 12 1300 percenter on trading QQQ in like 15 minutes. But the reason why you're able to do that is, one, because the delta is so high, but there is some downsides to doing that, and that downside is theta. Theta is the time decay. The price per day you're paying to hold on to those contracts. But the thing with those zero DTEs, that Theta is actively working to make those contracts go worthless, especially for out the money contracts. They have no intrinsic value. So when time runs out, guess what? Those contracts go to zero. 90 more than 90% of options at expiry go worthless. So yes, they can pay like crazy. Also, they can hurt you really bad. You're just going to get paper cuts until you bleed out. So how I like trading them specifically is, I trade the zero DTE contracts till around 10 11 a.m. my time, so until lunch pretty much. And after that time, I know that Theta is going to be eating away at those contracts really really quickly. So that's when I go out to the next expiry. So if I'm trading on a Wednesday, I'll trade the Wednesday expiry until the first 2-3 hours of market open. After that, I'm going to be trading the next expiry out. Why? Because one, I'm mitigating my risk. Two, I know I can size up on those and hold them on for longer throughout the day and not worry about Theta eating away at my contracts.
That's a pretty good strategy. And in terms of like what you were saying earlier with the, kind of rolling it up. So for example, if you're trading Wednesday, do you roll up into the Fridays, and then later on would you think about rolling into the Mondays, or do you just wait until Friday
I don't
rolls
swing
around?
any ETF contracts. I only day trade them.
Just because it's too choppy, right?
It's way too choppy. The thing is, I don't want, like, again, how I blew up my account the first time was, okay, so my journey for my portfolio, I went from 25K to 5K, and now I have over 1.2 1.3 million dollars in realized profits. And one of the biggest differences that I did to get to this point was stopping my swings, those erratic swings that I'm you know sitting up at night and looking at the chart, hoping that it's going to open higher than what I picked it up at. And I don't want to hope anymore, and especially when you're, swing trading ETFs, you're hoping that the futures are good. You're hoping that there's no bad news that drops overnight. So really how to mitigate that risk is by day trading those specific options, compared to regular stock where you can like look forward to catalysts. You can look forward to a lot of like the stuff like that. So it's in reality a bit safer to trade um, or swing trade options specifically for a certain stock compared to the ETFs. The ETFs are more technical based. There's no real like catalyst that you can sit there and try to bank on, right? Except if you're playing like federal meetings like FOMC or like job reports or stuff like that, and like you have some type of information. Like for the past few months there hasn't been jobs, and now there's a lot of jobs. So uh, you can kind of bank on movements like that if you're trading further out contracts. But I know a lot of people, especially here in this space, they're trading with smaller accounts, so you're really putting higher risk on yourself when you're trying to swing ETF contracts. So in my opinion, it's better to day trade them. That way you're in control. If it goes against you, you can just cut the trade, take a paper cut rather than bleed out your account.
That's great advice. And do you have a sense of how much your capital do you dedicate to index options versus single stock options? Is it a small portion, or is it 50-50?
No, I don't necessarily allocate my account like that. I necessarily take it per trade, regardless of like if it's an ETF or a stock. I don't really want to risk more than 1% of my account on anything, right? But again, like if I am opening up multiple positions on the same stock, then I'll put like 1% on like a shorter term and 1% on like a longer term, or even less, like 0.5% on the shorter term and 1.5% on the longer term one, just to mitigate that type of risk factor.
That's great to know, man. Thanks.
Yeah, of course. And, I know a lot of people on Twitter and in the trading world are doing paid programs, including myself. I run a mentorship. I know Palmer, Rhodes, Ace. They all have one, and they all each have their own specific strategy to to capitalize on. The way that I kind of do it is, one, I'm trading technicals every single day on specific setups that are arising as they come. I'm not trying to predict, but I'm sitting there and reacting as to what's coming. And how I do that is by looking at a few certain indicators. One of my favorite being the inflow outflow meter. Okay, and the inflow outflow meter is pretty much money coming into the market and money leaving the market. So imagine you're trying to play QQQ, you know, the tech index, right? And you're trying to go long on it. How are you supposed to go long if there's money bleeding out of the market? There's no one coming in to buy it up, no one coming in to take your stock up for you, right? So in that sense, your trade would be invalid at that point. You know, there is no uh, even if your technical setup is there, you won't have that push that you need to drive up your stock higher and make your trade work out in your favor. So I always look at that inflow outflow meter like 24/7. I'm looking at it while I'm trading just to make sure that you know, if I'm short, I need money to be bleeding out of the market. If I'm long, I need money to be coming into the market, and it's going to help your bias be validated, right? You know, and then on top of that, there's, you know, unusual volumes, activity. There's a bunch of different factors that you can be looking at. uh, Besides the inflow outflow meter, another super important one is tracking the VIX, you know, volatility index. And what that is ultimately it's the market's fear versus greed index. You know, when VIX is climbing, there's fear in the market. If you have a bias, a long bias, doesn't matter what the setup is, doesn't matter what the stock is, if the VIX is rising, you know, and there's no catalyst, there's nothing that you're playing on, just technical levels, you're probably going to be invalidated and lose money on that trade. So you always want to be tracking the inflow outflow and the VIX, especially when you're day trading, and especially if you're trading, you know, weeklies, day trading them.
Those are all great points, and I think that you know, right now, because the VIX is so low, I'm probably much more inclined to sort of be going long options. But when the VIX was higher, I did a lot of selling. Took in a lot of premium, and you know, that might be one of the difference between my way versus a lot of the folks in here. I actually have generated a lot of wealth just by, you know, selling a lot of options. It's also less risky from my perspective. You know, the way I titrate it is, you know, if I know a little bit about a stock, you know, I feel pretty good about it, but I know a little bit about it, like, you know, and then my inclination would be to sell 1 month or like up to between 1 month and 2 months short puts. If I know a little bit more about it, my preference would be to own the stock. And then if I know a lot about it and I feel very confident, that's when I go and buy the call. But that's just me. That's just, you know, my old ways
Let me ask you something.
of
Are you
doing
are
it.
you selling contracts that are way out of the money, or way in the money, or how do you do it?
I sell contracts that are just slightly out of the money,
Okay. Just to collect
and
more premium on it?
just to collect more premium.
But
And
you're
then I,
taking them on
like,
a
you know,
shorter term, right?
yeah, like 1 month to 2 month is
Okay.
typically how I do it. And you know, if it comes in, you know, 50%, I'll take like half of it off. You know, it's just kind of like over time. And it's also, it almost always, I never short puts unless I feel like, you know what, I'd be willing to buy like, let's say there's $100
Yeah,
stock
you
and
want to
I could
buy the
short a
stock
put.
actually.
Correct. And the shorts, you know, I can get a put for $7. And I'm like, you know what? I would buy the stock at $93, you know? And so that's, and if I don't, and if it doesn't get put to me, I'm okay. Like, you're just taking the premium,
So yeah,
you know?
I kind of do something similar to that, but slightly different. So, you know, I also sell options, but how I capitalize with more, you know, with less risk in a sense, is I like selling the weeklies that are way out the money. You know, like let's say for example, random stock. You know, QS. You know, QS has an insane daily range. You know, that thing was up to like, you know, $80+ at one time. And what option sellers usually do is, you know, they'll put strikes out there for earlier expiries that are way out the money. Okay, they have, you know, really really small premiums that you pay to pick them up. But guess what? People that don't know how to trade options are going to be picking those up because they're so cheap. So it's an easy way to capitalize on size, you know, on selling those options and collecting, you know, those smaller premiums, but, you know, on scale, of course, you know, and having less risk on your end, because the chances of it popping, you know, back to $80 from $20, you know, within a week, it's like almost impossible. You know, very very low likelihood that you're gonna get robbed of your shares, right? So I'm actually buying the shares myself because I like the stock, and then I'm selling way out the money weekly contracts to be able to fund those stocks.
That's a great strategy, especially like all of these stocks go through a period of massive volatility, and then they sort of start
Yeah,
consolidating. And as soon
easy
as you start
premium
selling
collection.
options, yeah, as soon as you start selling, because what happens is that the premium is based on the past's volatility.
Exactly.
So if you know that it's kind of like the buyers and the sellers have beat the shit out of each other and they're all calming down and it's going to consolidate for a while, that's when you just print money.
Mm-hmm. Like, for example, I was doing that with Wish. Like, I like Wish. You know, a lot of people would disagree. In general, like the stock enticed me. And I was looking at it around $5, like a little bit after the run up. And I wanted to buy shares, but I was scared of the volatility of the stock. Maybe it can go down to $1. You never know. So what I was doing, since this thing had a nice daily range, there was $20 options available. So I was just buying a shit ton of commons at like $4.85 and selling the way out the money contracts to be able to fund those shares that I wanted to keep for the long term. So I was buying those, and you can even do this in a Roth IRA, right, and avoid the tax on it. So you can keep those shares for the long term and pretty much fund them selling the weekly out the money contracts.
Yeah, those are for something like Wish, where like it was well north of 100 implied vol. That I think that's a fantastic strategy. I'm doing something similar to that right now with Any,
Yep.
ANY.
Yep. Very good one to do it with. But yeah, so there's most options traders now, they're just flipping premiums, but there's so many other ways to make money trading options other than flipping premiums. In my opinion, flipping premiums is awesome for day trading. It's fantastic, quick, easy money, and like you can just ride the technicals, whatever technical, like whatever indicator you like, you can use it, write it up, write it down, whatever it is, and then use your advanced strategies like selling your options, doing straddles, strangles, shit like that, and capitalizing the longer term, right, on the same stock while trading it in the short term. That's why I like taking those multiple expiries, because I want to be looking at the stock over a longer period of time, but I also want to be making money on it right now.
I think that's awesome. By the way, just that strategy you described, I'm doing that with all the crypto miners. I'm doing that with Mara. I'm doing that with Riot. I'm doing that with, I'm doing that with ANY.
Yep.
I just think like those guys just have incredible premiums. I actually think that there's a nice fundamental, basis to the story. Like Mara's dirt cheap even now. For a variety of reasons. And so it's like, look, it's going to be super volatile.
Yeah,
I
capitalize the
like
volatility
being
by the shares for the long term.
totally. And I'm like, you know what? I'll sell vol at like, I'll sell, options at like, get 10, $12 of premium. If I get it at 60, it's $60 versus 70, I'm okay with that. But if I don't, I just got free premium.
Yep, exactly. So here's another strategy I want to touch upon. Besides this, like we've been talking about selling options for a little bit, I just kind of want to move on from it. One thing that has been super relevant this past 2-3 weeks, okay, is earnings and how to really capitalize on earnings with the lowest risk. Okay, so there's this option strategy. Okay, it's called the straddle. Okay, so what that basically means is you're buying a call and a put at the same time. Okay, now if you're not very versed in options, you might ask yourself, well, how is that? How is that productive? How would you make money doing that? So, well, think of it this way: when you're playing options, especially just playing the premium itself without selling, without doing anything, just buying premiums, right? Your risk, okay, has a max loss. Okay, the max loss is whatever you're paying for that premium, but your upside isn't capped. You have like a pretty much infinite upside. Whatever the stock goes to, it's going to keep paying you. So how I like doing it is, especially during Q3, Q4, the closer you get to the holidays, there's always earnings overreactions. Whether you beat it by a cent, whether you miss by a cent, it's going to cause some type of drastic movement in the stock. And by drastic movement, I'm talking about like over a 5 to 7% movement in the underlying. Now, let's say you buy a call and a put, right? Let's say, I'm going to give a random example. Let's say stock X is at $20. Okay, you buy the $25 call, and you buy the $15 put. Okay, let's say this stock releases a great earnings. Okay, the next day it jumps to $30. The put that you have is gonna go to zero. Let's say you paid $100 in premium for each the put and the call. So your total upfront is $200. Your put is gonna go to zero if the stock goes to $30. That's a given. You know, you lose your full entire position, especially for a weekly, okay, on the put side. But guess what? Your call side doesn't have an upside. That thing is gonna pay you, especially if you're taking a weekly. Guess what? Those contracts are gonna jump. They're gonna jump 400 to 1,000+%. Guess what? It's going to cover your loss on the put, and it's going to leave you with some profit or a lot of profit on the other side. Now, the only thing, you know, this sounds perfect, you know, oh, I can profit every single time. The only thing that happens that can really cuck you in this scenario, you know, make you lose money, is if the stock doesn't move. If the stock stays flat or only moves up or down a certain percentage, both your call and your put will go worthless, okay, or you lose a majority of your money on it. So that's why when you're playing this, you know, earnings strategy, you really want to know what your risk factor is, both on your call and your put. On both of them, you only want to be putting what you're willing to lose all of. Yes, if it goes, it's going to pay you, but you also want to assume the fact that it can hold flat and you can lose on both sides.
That's another awesome strategy for when, precisely like you said, when you think something's going to move, because, you know, earnings is just going to, you know, bring tremendous information in. I'll give you a live example of it, or not a live example, but like a couple of weeks ago, Snap reported. So it was trading around $75. The 75 straddle. So you buy the call, you buy the put. I think it was like, you know, the 11/12. So basically, like this week's Friday, you know, this Friday's, like, you know, straddle was trading at like $7.50. So what that means is that, you know, if you keep it until expiration, you effectively make money if the stock goes below, call it 68.50 or 67.50, and it has to go above like 82.50, something like that. And so my buddy was like, look, like no matter what happens, whatever the number Snap comes out with, it's just gonna it's just gonna either blow earnings away, or it's gonna miss dramatically. And so, you know, the straddle was priced relatively cheaply. So that was an example of exactly what you're talking about.
Yeah, so that's, in my opinion, the best way to play the earnings, you know, is to take both sides. And, you know, especially if the setup is working in your favor, where, you know, you don't have an earnings run up or you don't have an earnings rundown, you're going to get paid either way.
You do got to have a view, though, that like it's going to dance and it's going to move right after earnings. Like a whole bunch of info is going to come out.
Yeah, exactly. Yeah, I know me and Rhodesa played one a while ago. We played you know, Lulu, and that thing, you know, we woke up and it was up like fucking 1,600% on us, you know. $50 paid us $1,600 per contract. So it's stuff like that where, you know, the money you're putting in, you want to be ready to risk all of, but also know that it can pay you like crazy. And especially if you're taking the weeklies, the closer to expiry, you know, the harder they're going to pay you. Like if you're taking them today and you're swinging them till tomorrow, Friday, where the contract expires, and you do get a dramatic movement like that, guess what? They're going to pay you like insane amounts. So it's super interesting to know that there are different types of strategies that you can use to capitalize on those type of movements or those type of events, you know, especially for earnings. And you can play them and mitigate your downside. You don't just have to play the call or the put. You know, you can play both. You can play both and, you know, more than likely win. Rod, you came back, bro.
Yeah, I'm here. I had a question for either MG or you. What do you guys typically like to look for after earnings? I've spoken to Brady Crypto about this, and he has his take on it. For bad earnings specifically, he lets it settle a little bit, lets it base. Know that kind of what we were talking about with MG a little earlier. You know, you're not in consolidation, nor are you in an uptrend. You're in a downtrend now, right? And it could be picked back up. But I was just wondering how you guys typically approach options, especially after earnings being bad.
Yeah, I can just give my experience. I've typically almost always lost money trying to chase stuff like that afterwards because I'm looking to, catch the proverbial knife as it's falling, and it's not fun. And for me, like, I'd like to wait at least several weeks until it bases. The interesting thing on a lot of names is that when it moves a lot, for some strange reason, in some names, people like the premium goes up significantly. It's almost like people like to buy even more insurance because they think a greater disaster is going to come. But then in other names, the premium just shrinks. They think that like that nothing further is going to happen. So I really like to look at the implied vol movement after earnings on a drop like that. If the implied vol has shrunk quite a bit, it gives me more confidence that it's going to trend for some reason. And then if the implied vol is elevated or is still pretty elevated, that's when I look for like slight bases, and that's when I'll do the selling option strategy. I don't know. How about you, Bullshark?
Let me finish my cookie. Rhodes, speak.
I was going to say thank you for that answer, MG. Do you see any different scenarios, or how do you approach something with good ER? Because you were saying how, typically when it does have bad ER, you will stay away from it because you will typically lose, but without, waiting a few weeks. But is there any rule of thumbs or any tips you have for good ER?
Yeah, with good ER, I like to look at the technical indicators just to kind of see if the momentum and the trend is still good. I like to see lots of volume come in. I'd like to see people like, if I'm a little old school, so I still like the Sam Weinstein kind of approach. I don't know if you guys read any of those kind of technical books, but he basically kind of categorizes all stocks into sort of 4 stages. And stage 1 is kind of where it's basing and ready to go. Stage 2 is literally when it's in an uptrend. Stage 3 is when it's kind of based after an uptrend, and then stage 4 is when it's kind of on the decline. And so what he likes to look at is the 150-day average, and to see if kind of like the stock is comfortably above the 150-day average. He likes to see the 150-day average trending up, and he likes to see a lot of volume above that. So if someone comes out with great earnings, they beat, it's still above the 150-day average, there's a lot of volume on there, that's when I'm like, yeah, let's keep going. I'll kind of like, look to buy a little bit out of the money. And, I like to buy a little bit of time just because I'm super scared of the weeklies. I got to be honest with you. I like to buy at least a month out, maybe sometimes 3 months. And, I'll buy it like, 10 to 15%, depending on the vol, 10 to 15, 20% out of the money. And I just like to kind of ride it up. But that typically for me is how I like to play, an earnings beat where it affirms the trend.
Yeah, I'll add to that a little bit. So I I like specifically playing the downside continuation rather than the upside continuation. And I'll tell you why. So there was this one specific one that I was playing. It was PayPal. So PayPal, I think it was last week, they had like a bad guidance. On top of that, they had a bad earnings. So a couple of people posted, I'm not going to mention who, about a bounce for PayPal. And I wrote a comment about that saying, hey, I don't think it's going to bounce. There's actually further downside coming. And why I had that bias? There's a couple of reasons. One, there's a general market outlook that you have to consider too. So it's not only just the technical for that specific stock, but it's also how the general market's doing. So at the time that PayPal dropped, Apple was also reporting earnings. QQQ had just gotten to its all-time high. It was finally starting to do its pullback thing, and I'm like, okay, you know what? From here, you're gonna have a lot of tech reporting earnings. You're gonna have a lot of outside influences pushing this specific stock that you're trying to trade. It's gonna influence the movement, even though they're not correlated at all. They're on the same index, and it's going to ride the index. Remember how I mentioned you want to be looking at the index that you're trading and the weight of that stock on the index and how it's going to move based off that, right? So just based off that index weakness, I was able to continue my short on PayPal, even though it had already dropped. I said, this is going to go lower. Why? Because, the market was pulling back. It had already reached new highs. On top of that, it had earnings coming up. And, people don't really want to play a bounce right before earnings. That earnings is the riskiest time of the year for the stock, right? So again, the upside, you can play the continuation, but your risk reward there isn't going to be as defined as if you're trying to continue on the downside, in my opinion. Again, just really depends on the market outlook at that time.
Yeah, that's actually brings up a good note too. So, I think it was the week Tesla had earnings, which was 2 weeks ago, I think. You had a bunch of other stocks have had earnings as well. So when you do have like a big earnings week, it's best to, unless you've been holding the swing for a little bit and you're up on it, to
Yeah,
definitely
you don't want
not
to open a
take
new position.
swing trades, whether it's on that one that has earnings or whether it's on anything else, because it could be a sympathy scenario. Even if it's not a sympathy scenario like AMD, NVDA, right? AMD has bad, then NVDA is likely to go down. It could be a scenario where it could be like Apple or Microsoft. If you guys don't know, they both of them each occupy about 10% of QQQ each, right? So that's 20% total. So if you get bad earnings on Apple, it
Exactly.
can drag
Thank
down the
you.
entire market. Yeah. So just be careful with that. I guess another question I have for either MG or you, Bullshark, I've tried to figure out a consistency in terms of trading the ER run up, right? So do you consider an ER run up like within that week, a few days before, the day of, or like weeks before the ER run up? Because I've noticed like trading it that week, the week of, it's typically not necessarily a run up. I mean, sometimes, but I haven't really found a consistency. I will say that I haven't been using Flow to gauge that. I don't know if that's a beneficial to do in a scenario like that. But how do you play an ER run up if that's a strategy you play at all?
I necessarily don't ever play an ER run up. I'd rather play the ER itself the day before using the straddle strategy, and I'm just more
Okay.
successful doing that. But yeah, if you are trying to play, like 2 weeks before the ER, then definitely flow is something to consider. Those large scale orders, people always know something. Whether you want to believe it or not, there's always going to be insiders. There's always going to be people that know some type of information that you don't know. They're going to tell their friends that like large firms are going to know, and you'll see them putting block orders, bro. And that's specifically why I like using unusual whales, is because like, you'll see those orders. You'll see them coming in, and you'll see how big they are.
Yeah. So I guess I'll speak on that too. So for Flow, Um, just to give you a little background of myself, I don't use trade ideas. I
Yeah, I
haven't
don't
for
use
a
it
year.
either, bro.
Complete waste of money. Fuck trade ideas. Um, don't get trade ideas. But for Flow, I was kind of approaching it in the similar fashion. I'd be like, like in my opinion, the way I see a chart is no one knows anything 100% certain. Obviously, if you have multiple bull orders on something, that could signal something, right? But for me, I'm fairly good with charts. I have a strategy, a disciplined strategy I trade off of. I think flow is interesting and neat. It could act as more of a confirming indicator than anything else. But for people out there, I don't necessarily think it's you need it, right? It's just nice to have if you do have it. I've honestly only used it once though, so I am a little biased, but I trade pretty well
Yeah, I
without it.
agree. I would never open a position just based off the flow itself. It's for me just to kind of confirm or like disprove a bias that you have. Something that I specifically like better than a flow. So, if you're trading with Thinkorswim, you can click on the trade tab and open today's options and statistics, or today's options and statistics, and there's a time in sales or like a level 2 data specifically for options, and you can go see exactly what strike and what expiry the biggest orders of the day are being placed at. So if you're going and trying to open a position today, go look at that level 2 data for the options time and sales, and you'll see like, oh, in the short term they're loaded on the put side, in the longer term they're loaded on the call side. So you're expecting like not necessarily a run up towards earnings, but a short term downtrend, and the longer term like a bounce off of it. Again, it's not necessarily
Yeah,
something to take to heart, but it's something to consider when you're trying to open your position for a swing.
yeah, and like I said, I do have a bias on it. I know people who actually trade strictly based off of flow, so it's just another means of trading, right? There's a million ways to make $1 million in the market, so I'm not like hating on it if you use it or saying don't use it. It's just if you're someone who aligns more with the way I see things and the way I see things, I had to voice out in case someone does align with it. It's just my perspective.
Yeah, my 2 cents on the flow thing is that I think you got to be really careful. I think there is some information there, but you got to like really kind of dig deep into it. So, for example, if you look at large cap companies and you see a big flow, you know, like for example, let's say you see $1 million, $2 million with a premium for the big funds, that is nothing. Like that literally wouldn't amount to anything to them. For an individual, that would be a huge amount of premium, and you might think, oh my God, somebody knows something. But for a big fund, that might not mean anything. Also, they could be selling premium. So, they're just like, maybe I own Tesla. I'm going to sell a whole bunch of premium on Tesla because, I just want to kind of do a right call. Versus like, if they're on the ass side. And so you got to be aware of all of that stuff. With regards to earning run-ups, I think that, I don't see how you get around personally. This is just me. I know that there's great technical traders here, but I don't see how you get around having some sort of view on what's going to happen with the sentiment around the stock or what's going to happen with the story.
That's the trick. You
I think
can't,
that
bro.
that's really it. Yeah. So I think people who don't have a view on that and they're relying on, other stuff, I think the worst thing in trading is to be in a situation where it goes against you or it's sideways and you don't know why you're in it. That's the worst fucking feeling. You don't want to be there. So, you know, so I typically, if I don't have a strong view on earnings, kind of starting, and then, if I have a view on like the sentiment, it's hard for me to get buzzed about, what other people are doing. Cause there's a million ways why people sell all the time. They could be divorcing. They could be like, who knows? Usually they only buy for one reason, but people sell for all kinds of reasons.
Facts. Just wanted to say what's up to Trog and Pat. Welcome, guys. What's going on?
Hey, Trogdor.
What up, bros?
How's it going, bro? I miss you. What up, Pat?
What up, guys? Just absorbing a ton of knowledge right now.
Oh yeah.
Yeah, just
I looked at the small cap scanner, man. The penny dogs are mad.
they're mad, bro. You gotta eat the chili dogs for them. No, I've been fucking around a little bit with some like auctions, some more options and shit.
Yeah, boy.
And yeah, just kind of listening right now. It seems to me that during earning seasons is really when options start kind of going a little bit of haywire. I haven't obviously traded options for very long at all or anything, but if anybody has, what are your thoughts on that? Have you seen, during earnings, they become a bit more volatile and there's a lot more, I guess, profitability there? Because, obviously commons, nobody wants to get in the commons. Nobody likes trading through the ERs. So, there's not much volume in commons during, this earnings season. And then afterwards, it'll pick up a little bit. So, just wanted to get y'all's thoughts on that.
Yeah, so I kind of touched on that a little earlier. Didn't really all too much, but I noticed I couldn't find any consistencies in earnings the week of or a few days prior, because that's what led me to the question of asking them, how they played it. But yeah, I mean, it is a little bit volatile. Sometimes, if the sentiment is bullish, you'll see that through the price action, but that doesn't necessarily mean, overnight this, if it was bullish this day, it could be bearish the next day, and then the next day bullish, and then earnings and whatever. But yeah, so I guess it's pretty volatile. But I don't have a trading strategy that capitalizes around that. It's mainly just
yeah. So that's one of the things that I was mentioning earlier. I don't know if you heard, Trug, but there's an option strategy called Straddles, where you can take both the call and the put, right? So that way, your max risk is what you're paying for the premium, So if it goes against you on one side, that side is going to go worthless. But the side that runs, especially on earnings, I see, like, I'm sure you see, like, they go crazy, especially on like especially if you have like small wins or small misses. If you have like small wins or small misses, uh, the earnings will shoot up the stock or drop the stock like crazy. I'm talking about like more than 8 to 10% at a time. So the side that's a winner is going to cover your loss on the losing side and leave you with some more. So that's pretty much what a straddle is. And
Yeah, I spoke to someone about straddling like that before. He says what really fucks you over is when
the whole flat.
the earnings finish flat.
Yeah, bro. That's the
Yeah,
worst
so
case scenario. Then both sides go worthless on you.
yeah, no. Yeah.
I've been speaking to a lot of people who transitioned from small caps to large caps. Again, including myself. It's not because I couldn't make money in small caps. It's just
There's so much
because
money, bro.
I'm done with the bullshit there. Yeah, there's so much money in large caps. It's just easy mode all the time, really. But with that being said, for people who swing, you might have gotten fucked with a small cap swing trade, and you might be a little, you have a little PTSD. You guys got to understand that when you get into swinging large caps, you're trading tickers that have great fundamentals. You're trading some of the best companies in the world. As Bullshark once said to me, the stock market's designed to go up, and when you really put that into perspective, it kind of gives you a good glimpse as to having confidence in a swing trade, as long as you're not being an idiot and you're trading good technicals. But in addition to that, go look at the weekly chart or the daily chart for SPY, QQQ, IWM, right? They fucking
They
like
go
to
up,
go
bro.
up.
They
So
go up.
just, you got to realize that most of the money that I've earned, whether it was small caps or large caps, is in swing trades. And in large caps, it gets even easier because you're just fucking riding a wave, right? So that's why when I trade a large cap, I know Dr. Bullshark and MG were talking about it earlier, and how the newer retail traders typically like to trade that uptrend. That's exactly what I'm capitalizing on, right? You got stuff that's in pretty good dips at the bottom, but there becomes a lot of problems when trading those bottom dips. You don't know how long it might be down there. You don't know if it's going to be choppy on the way out, and then that could definitely impact the timing for your option contract. I like the ones where it gives you a shorter time frame of a trade, and it's just quick and easy money, really.
Yeah, I wanted to, I guess, go into. I know a lot of people. Obviously, there's a lot more volatility in small caps. So where do you guys find trading small cap options fit in? I've played a few. I've been relatively successful just because of sentiment and sector rotation. Um, but what are your thoughts on that? How, do you do it? And because I know a lot of people will be interested in it, but obviously it's a bit more risky than scalping the weeklies on large caps.
Yeah, definitely. Bullshark would touch up on it, but in short, it's more of a high risk, high reward scenario. You definitely don't want to put the amount of size you would be going into a weekly or a monthly on a large cap into something like that for various reasons.
Yeah,
Hopefully Dr.
I
Bullshark
can
will
definitely
comment
touch
on.
up on that. So, I mean, think of it this way, especially with large caps, there's always more money that's going into it, right? So, it's similar to small caps. You can kind of predict, where it's going to go, but you don't necessarily know when it's going to go, right? So, there's a certain criteria that I look for when I'm trying to swing small cap options. The first criteria I look for, number one, is volume and open interest, right? You want some type of liquidity on those contracts to be able to unload them once you pick them up, right? So if you pick up something with no volume, no open interest, even if the trade does end up working out for you, you won't be able to offload your contracts. Okay, so that's the first thing. Second of all, you want to be looking at implied volatility. Okay, with smaller caps, I've realized that they have quite high implied volatility. So why is that a problem? You came kind of late, and I touched up on it earlier, but implied volatility it's an extrinsic value that's added onto contract premiums, right? So if you have a contract that's in the money, for example, it has an intrinsic value and an extrinsic value. If you're trading a contract that is out of the money, it only has extrinsic value, it has no type of intrinsic value. The only value that it has is pretty much time and implied volatility. So
Right, it would be speculation value
exactly,
basically.
exactly.
Yeah.
So the the only way to kind of be profitable on that, right, is if you get those out of the money contracts to go in the money. The only other way would be to get an implied volatility spike. So what that means is you want to be buying a contract that has low implied volatility from the start, right? So when you do get that movement, right, now you're not chasing it. Like on a large cap, even when it's going up, you can play it because the IV isn't going to spike too high. But if you're trying to do that on a small cap, the IV is going to jump almost immediately. And if you do try jumping in, your profitability margin is going to be a lot lower, right? So,
Yeah.
Yeah, and that's where Dr. Bullshark and I had a conversation the other day. From that, what Dr. Bullshark just said, you can see where manipulation becomes a huge factor in small cap
yeah,
options
big time.
and mid caps too.
So that's exactly why, like, if you do plan on taking a small cap option, in reality, it's better to take the longer term expiry. Whether it's a leap, whether it's a couple months out, or whatever it is. Generally, you're gonna have lower IV on it, and you'll be able to size up on it and not be scared, one, for the theta decay, the time decay, for your contracts going worthless. And when it does pop, you'll make your money doing that
Yeah,
way
man.
instead.
No, I found more success there because, especially small caps. Not only are they manipulated, but the ones that trade options are even more manipulated than the others. Just think about how much money, market makers make by trading something sideways.
Exactly.
Nobody, so a lot of people they call that farming.
Yeah,
Option
they're
farming.
farming, bro.
Yeah, so it's really just option farming. How long can you keep something sideways? And every time someone comes in heavy with this, strong put or call, once those expire, worthless,
They'll let him go.
you lose all your money, and that goes straight to the market maker or whoever it might be. So that's something to, I guess, for people to realize in small caps, and why it's important to look further out rather than play the weeklies. You might get lucky with some news or something, but overall, these things are controlled pretty tightly.
Exactly. Yeah, for small caps, I feel like it's better to play.
I was wondering if you guys
catalyst.
could touch on scaling in a little bit. I don't know if you already did.
Yeah, I can do it.
Awesome.
Yeah, we talked about it a little earlier, like specifically for scaling in and scaling out of contracts. So for day trading, I mean, it's the same thing as trading small cap, right? Like, there's going to be a breakout, a retest, and a run, right? So how I like taking my positions personally is I like buying at the ask, right? I'll take my starter at the ask, because it's gonna have a spread, the bid ask spread. And if you're trying to get like the mid price or at the bid, a lot of times you're gonna miss out on the run just because you couldn't get your fill. And usually that fill is like a couple cents, right? So my point being is don't avoid the run up by trying to save a couple cents. Take your starter at the ask and put your orders at bid and below, just so when that retest happens, you can get your fill, you know and then ride the actual play out.
I love that. That's great.
So
Thank you.
Yeah, and for me, I'm not even like tooting my own horn, but I've gotten pretty good with timing. So when I have to scale in, right? Because you can't just do, well, small caps more so, but I got used to being able to just slap the ass sometimes, and especially with the large cap, there's not going to be no manipulation on that. But for me and my strategy, what I typically like to do is, it's a general spot, right? It's a very tight general spot. It's not like some of the supply and demand zones you'll see on Twitter where it's like it touches the top of it, and then it's like there's a whole like 50 yards at the bottom of the demand zone that wasn't even met. Like
that.
I fucking hate not getting full fills. Some strategies go with, get in 25%, ride that up. Like, no, I like to get in my full position or damn near close to it. So I'm gonna have bids, but I'm gonna definitely make sure that if I see confirmation that it's heading out, that I'm not going to be like, oh, I missed this by 10 fucking cents, right?
slap that ass, bro. Slap that ass.
Yeah, and there's sometimes a negative connotation with doing that, but like if you're thinking bigger picture, right? You're not trying to scalp on a 1 minute time frame, especially for swings, right? You don't want to go be anal about 10 cents or 4 cents, right? And then have it go, way up. Just get in the position. I've seen so many people miss a huge move because they
Trying to save the pennies, bro.
I'm
trying to
pretty
save some pennies.
notorious for that. I'll just fucking I don't bid in. I'm just like, fuck it, I'll just market buy this bitch.
Hell
And
yeah,
then,
get the fuck in.
yeah.
So yeah, that's in the sense of day trading. That's like the best way to, kind of get in. And I was telling, like I've taught Rhodes the strategy a while ago, but for strikes, right? The in the money contract is gonna move the most fluidly with the underlying, right? But the ones out of the money are gonna pay you better, right? Because they're gonna gain delta. Pretty much when you're trading premium, you're trying to make money on the delta. Now,
Right.
The best way to do it, in my opinion, is split your bag. Take one in the money and take one out of the money, right? And as this play is going in your favor, now you're scaling out of the ones that are already in the money, right? And you're waiting for the ones that are out the money to go in the money, right?
Sure.
So that's like the best way to scale, and in a sense, you're rolling over your contracts to the next strike and continuing on the movement. That's how you capitalize on the delta, like
Yeah.
the most
And
popular.
pretty general. Like a lot of people put like all their money into one strike.
Yeah, fuck that.
Fuck that. Go look. You can put it into 4 different strikes, or you can, say you're trading with $1,000 for options. Why not split it into 4 different, 250, 250, 250, 250,
Exactly.
and then because some you might get lucky and it keeps running.
Exactly.
Or so the whoever comes in might slap. Say you have the $5 calls and the 750s go. What's wrong with splitting it across, because there's so many different option chains that you don't know which one's going to get hit hardest.
Right.
Yeah, and with that, hopefully you guys see a bad or what I mistakenly did when I first started, and what I've seen a few people do is obviously with the ones further out, right? Those are the ones you're letting ride. So that does not mean those cheap out of the money options are what you should go to, right? You have to always remember that those are high risk, high reward scenarios, right? Those are played with less size. So definitely don't think that those out of the money contracts, although cheap, are they do come with their disadvantages if you're just putting all your money.
Yeah, a lot of
I
times
have
the
I have a
spread is a
question
lot
about that
bigger.
strategy, guys.
Sure.
Like let's say you have a sample stock that's like $45, and so there's a 50 strike, 55 strike, 60 strike. So you buy 50, you buy the 55, you buy the 60. Let's just say, for shits and giggles, it's 10 contracts each. So obviously you're going to get the biggest bang in terms of the return on the 60 strike. So are you saying hold that last
Yeah,
and take profit on that last, or take
exactly. That's right.
Got it.
Yeah, those are the ones you're letting ride with smaller size. Those
Yeah,
are
because
kind of
even with
just
smaller size, they're gonna pay you hard, right? So you want to put like the ones with the most risk on the smallest size, and the least risky ones on size, right?
yeah. And
So
another
wait,
thing
so
too.
you saying you would have different amounts on each one, or you're saying, so I'm not sure, is that what you meant?
Yeah. So instead of taking 10
Yeah, so
contracts of each, take 15 contracts of the one closest to the money, and less the further you go up.
Got it.
yeah, and even then, you guys don't overcomplicate that. If you're in a smaller account scenario, you're probably not going to be doing that either. Just stick to one contract, and then as you grow your account, start to do that. But another thing that I might have just had a brain fart on. Yep, it's not coming to me. Maybe it'll come
Okay.
to me in a
And
second.
then for swings, scaling in and out for swings, I mentioned this earlier too, So on a swing, you can take a little further out the money because you're giving it more time on Theta to fulfill. But let's say you're day trading, right? You don't necessarily have to, play the weekly for the day trade. Like I taught this to Rhodes, and I'm sure he's been using it and banking hard off of it. But you can take size on the expiry that's further out, and you're gonna deal with less volatility. Yeah, those contracts aren't gonna gain as much percent gain compared to playing the weeklies. But if the trade goes against you, you're not gonna stress as much about it because it's not as volatile, right? So you can size up on a contract that's further out, and it's gonna pay you the same as taking small as a weekly contract.
That's what I've been doing.
Yeah, and what you also see with the taking monthlies for a day trade is the ability for you to hold it
Exactly.
overnight, right? Whereas if you're taking a weekly, you're gonna be in a little bit of a different situation depending on the day of the week. But you're gonna, if you realize that the higher time frame's looking good and you're in a strong trend, and there's a high probability that you could gap up or just have strong
Continuation.
trend continuation, which you'll likely see on large caps, because when they find their trend, they go with it, right? It's not like small caps where you have to constantly be on watch of this happening or this happening. You know, it goes with the flow, right? It likes, the trend is your friend in large caps. So you do have that ability to potentially overnight it and or hold it for a multi-day swing, even if your thesis was just a day trade. Sometimes it does turn around to be like that.
Facts.
Listen, guys, thank you so much for letting me onto the dais here. I got to hop, but just my last words is I totally agree with what Rhodes said. You know, if you're trading options and you're long, the trend is your friend. If you don't got a trend, do not buy unless you have a trend.
All right, MG.
But thank you so much, fellas.
MG, we really appreciated having you on.
Likewise, man. Have a good one, guys.
Take it easy.
And in addition to that, so in small caps, you often hear people say, you know, don't fall in love with those tickers. In large caps, the reverse is true. Like, you want to marry them. You really want to get to know them. And because the more you get to know them, right, because assuming you have a good watch list where you're trading those tickers every single day, like Apple, right, you want, the more you get to know them, the better you're able to trade them. That just gets into understanding the personality of the ticker. And that's what's super cool about them. Like I know for a while, Kerry Palmer, I think he might have left, but he was just trading Tesla off of open because he understood the personality. He said it like aligned with the MACD and whatever on the 1 minute or something like that. Whenever it dipped, he'd go long. Whenever it spiked, he'd go short. But understanding the personality is super, super important for large caps, and something that you see in small caps, but it works entirely different way, right? Like for small caps, it's like, oh, this one gapped up. We know that one likes to run, or we know it's kind of shit. But after that, it kind of goes and does its own thing for a little while. And maybe you swing it off of a swing trade personality, right? When it does get back to the gutter, it's a good entry. But for large caps, it's you really want to learn those personalities.
See me. I trade like Disney and QQQ damn near every single day. It's because I've been trading those stocks, those two specific stocks, like every day for like 2 years. So once you see what it does every single day, you know what it can do and what it probably will do. And then you align that with the technicals, and your likelihood for success is going to be a lot higher.
Yeah, I actually learned personality a bit from Pat. I knew for a while he like just traded plug, and every day he traded it, he knew exactly what was going to happen from it. And back then, like I was like, oh, that's sick, right? That's a way to trade something in small caps when things might be slow. You can just continuously trade your favorite ticker, or mid caps, right? But in large caps, it really didn't click again until I started to talk to Bullshark, and he really loved Disney. And Disney has a strange personality. It's really not my favorite, but nonetheless, it has a personality you can trade off of. They all have different personalities. It's just something you have to study. And if you, on the historical charts, and if you don't want to do that, then the best way to study the personality is to just stick with one every day, right? Go study the personality of something that's being actively traded, not just something that's, you know, in an uptrend right now and might fall, like, you know, maybe mRNA and PFE. You know, you can understand their personality, but in the long run, you're definitely going to want to stick to the ones that are always going to be there, such as, you know, the indexes, QQQ, IWM, and SPY, as well as the bigger companies like Apple, Microsoft, right? Those guys aren't going to go anywhere.
Yeah, just to because I'm new, I'm not going to talk much, but I'm pretty good at asking questions that listeners are probably thinking. Most listeners here probably have smaller accounts, and they're wondering probably about PDT. Say you're under PDT, they're gonna you got to wait 3 days. But in my for options, it's a lot different than trading commons. Can you all go into that for everybody listening?
Yeah, so just right off of the bat, what you'll notice from commons under PDT is that it's T+2, right? It takes 2 days for your funds to settle, which means you are likely going to be using 50% of your capital every day, so you have 50% in the morning. That's assuming you're not swinging anything, and that's assuming that you're using the equivalent amount every day. Sometimes it's a super hot day on small caps, and you want to decide, let's deploy all that capital today, right? But in large caps, again, assuming you're not swinging anything, if you use with options, if you use 100% of your account today, and you sell all of it by end of day, you're gonna have 100% of your account
Tomorrow, yeah.
in the morning. So that's a very good advantage for options. And again, it's not what you guys see. It's not a scenario where the risk to reward is. I honestly like, and this was just like maybe half a year now. It's like 4 months ago, maybe now, when I first started. I thought you needed a 50% down risk but the reward was going to be like 300%, 200%. So in the long run, it counterbalance. But what's also true with if that were to be the case would be um, you can't really size into that, right? That's just too much risk. But that's definitely not the case for options. Just know that you kind of get to decide your risk. It's definitely not a scenario where there's no risk,
The
but
risk is
you
in your
choose
hands for
further
damn
out
sure.
expirations
Yep.
to define your risk. Yeah. Weeklies being the most volatile as you get closer to Friday when they expire. That's where they're just stupid, right? That's where you see people post their big gains. Also, where you see people post their huge percentage gains are on things that are further out of the money that eventually go closer in the money
On a weekly.
or
Yep.
in the money, right? Again, on weeklies. But you guys have to know with those, like, I'll be honest, like, full transparency, when I hit for swing trades, they'll go well beyond 100%, and I'll just ride those. But for day trades, if I'm trading a weekly, and you got to assume I'm trading it with size, if I'm up, 40, 50,
Out.
70%, I'm out, right? I'll leave some to ride, but like that's 40% and 70% in like minutes,
Facts.
right? On heavy positions. Like I don't care if it's destined to go 1400%, right? I don't care about that screenshot. I care about
The money.
being comfortable in the trade, actually being in the trade and getting my fucking money, right? I don't care about going to post those. And often the posts you'll see on Twitter have no P&L back behind it. It's just the percentage. So that just means, in my opinion, they're maybe only holding like 10 contracts of that. It says, and they're definitely not holding full size. I'll tell you that.
And if so, that's good for like the people under PDT, because a lot of people are like, well, how do I get around not doing cash and being able to use my money quickly? Well, options is one way. It is more dangerous obviously than commons or not, as long as risk reward. But say you're a trader that's been struggling, you've been trading for a year, 2 years, you're really good at technicals. I know a lot of people here listening are probably really good at technicals, but just somehow can't get the trade because they're sticking in small caps. Maybe to something what's similar to what Rhodes said or Bullshark. Technicals and large caps, they don't lie as much, I suppose, than as small caps would. So, would you guys agree with that for those guys listening?
OP, bro. Large caps are where it's at, man.
They're
They can't fake you out on. There's just too much money coming in from all sides to really fake you out.
Yeah, so I was huge on understanding volume in small caps. If you guys know Maple Stacks, very good trader, he'll draw those lines on the volume. That's just volume breakout level. I taught that a little while back, but actually on my large cap charts, even on my mid cap charts, because I just know that the ones that I'm on my watch list are fairly good personalities, but I don't have volume. I just have a filler, which is MACD, which you'll often see a lot of respect on MACD and large caps. For small caps, absolutely not, in my opinion. But I honestly, I don't even look at MACD. It's kind of just a filler. I just know that like if you go look at like a small cap stock, you'll see that the volume is a very volatile, right? You'll be able to see volume increasing. You'll be able to see significant low volume pullbacks. For large caps, what's typically the story is you have big spike in the morning on volume, and then again, this is the 5-minute volume bars, and then pretty much stagnant volume all throughout the day, and then big spike end of day.
That's it.
That's pretty much
And
your
that's
volume
across the board.
story in
Doesn't
large
matter what
cap.
the ticker is.
Yeah, and but anyways, it's definitely not stressed on volume, and why I brought that up though is because when you are trading technicals, you just assume right off the bat, since you are trading, or what I'm trading is tight spreads on really good companies that have great fundamentals, right? If there's a setup in there, I'm gonna take that setup, right? Whereas if because there's going to be volume backed behind it, right? This is the Great American Stock Exchange, right? You're going to have volume on it. Whereas in small caps, it gets to that situation where we used to talk about the competition for volume, right? It's and the next best setup on how those both tie into each other. But I won't get into that. But yeah, TA a huge appeal for large caps is that for people who do transition is that TA is a hell of a lot more respected and more reliable. There's less fake outs, less manipulation. Does that mean that anyone who listens to this voice is going to have, become a millionaire in the year from trading options? Absolutely not, right? It's an entirely different game. So if you do come over, you just have to realize that you're not playing in the same game, right? It's apples to oranges. It might better align with you, and you might do better, and you might not, right? And I'll be real, like some people are out there, and no matter what you trade, whether it's forex, whether it's crypto, you're just not built for the markets. That's a sad reality that I've come to see in the past few years of trading. Some people just aren't built for the markets, and that's largely due in part to their personality, right? They whatever reasons they were just raised to not really take risk. But some people it might align. Just one thing to note though is you don't want to continuously jump back and forth. So if you're going to large caps and small caps, that's great. You'll learn it all, like Zach Morris said. But there is a point where I guess it's not necessarily for small caps and large caps since that's so apples to oranges. But when it comes to strategies, right, stick to a fucking strategy, right? Too many people are bouncing around trying to find this key, right? This key. And I kind of did in a similar fashion. If you guys use Thinkorswim, I discovered ThinkScript, and they have a bunch of cool indicators on that. And I was like, holy shit! Like I was like going through a loophole at night one night on it. I was finding all these dope ass indicators, and then for about a few months, a few weeks after, I was trading with like 4 indicators on my chart, only to go back to naked trading at the end of the day. You just have to realize that there's beauty and simplicity, right? Whether that be trading indicators, whether that be trading a strategy. So just make sure you're not like going back and forth, and in going back and forth, you're obviously overcomplicating things. So just make sure you're, headstrong with one strategy. There is a point in time where it's like, oh, maybe it's been like 3 years and something's not clicking with this strategy, right? Where you got to realize, okay, maybe let's go try supply and demand. Trading as opposed to breakout trading, right? That is true, but just make sure you guys aren't being impatient. That's a huge thing that FinTwit does to a lot of minds. You see all these guys make $1 million in 6 months, make $1 million in a year. You have to understand that FinTwit only highlights the outliers, right? It does not highlight the mass majority of people who are indeed struggling on a daily basis. So just when you're on Twitter and you see all that, you have to realize that more people are in your situation than you think. It's not everyone's green, right? That's a huge thing with FinTwit. Everyone's always green. That's definitely not the case in reality.
Yeah, I made it to a point where if anybody started posting gains, I just muted them, so I never saw it anymore when I first started trading, because it is pretty almost demoralizing. Oh shit, everybody seems like they're up 10 grand on the day, and I'm down $100, $200. It's best to just kind of get that out of your brain.
Everyone's got their own story.
And what I always say too is like, you take I've tweeted this, you take two people, person A, person B. Person B is the one who made $1 million in a year and they're like 20 something, right? Person B is someone who has a full-time job with kids. The amount of screen, and you're comparing person A started a year ago and you started a year ago, or person B started a year ago, right? That person B definitely does not have as much screen time as person A does, who was able to study the screen every single second of the day and at night. And again, it goes a lot into your personality. That's something that I noticed quickly and early on in the market, is that it'll really reveal some truths that we unconsciously try to hide behind some walls that we put up on ourselves. It's really about getting to know you or yourself. Like for example, when I was learning strategies from a variety of different people, Bearfucker, Trogdor, Brady, there was things I admired about them that I really wanted to learn for myself. For example, the most prevalent one that I could remember right now is Brady's a swing scalper, right? He has a price target. He likes getting in low, holding that core position, scalping on the way up, adding the dips. I love that, right? He's continuously compounding. And if the play doesn't work, then he's green on it. He's taking advantage of the volatility. But for me, as much as I love that, it did not align with my personality. I like getting in low and I like just fucking holding, right? Very similar to, I'm not comparing myself to Zach Morris at all, but more of that buy and hold mentality, right? Where you just get in low and you have high confidence and conviction in your trade. That's what my personality aligns with more, even though, even to this day, I would much rather prefer to be able to swing scalp like Brady, right? Dr. Bullshark is very good at swing scalping too. I just always, I get into that state of, oh, is this a good dip to add a higher low on? Should I be selling this spike? And when you start to overcomplicate things in the market, you're removing that simplicity factor, right? So you need to know and avoid those situations when they do come about.
Another thing that I think a lot of people might ask is, they see options, they see 5 different theta or whatever Greeks, and they're like, oh well, you got to know, there's 20 different options to choose. I don't know which one to take. If there were a set of 3 rules, and most people are like, they want to see those instant gains. That's the kind of culture we are in traders. But if we're looking for instant gains, maybe people just want to make 10 to 40% a day. Okay. What are they looking at to do? If they say they know their technicals, they've been trading for a little bit, how can I make that 20% and be happy? Because that's what most people want right now.
Sure. I'll talk on that for a sec. The number one is delta. I can't stress that enough. Like, if you're day trading, if you're trying to make money on an option premium, like just straight up buying a premium and reselling it for higher, you want delta. The best delta to be made is on one in the money contract, like one strike in the money. Take that one strike in the money, the stock goes up a little bit, sell it, you're gonna make good amount of money, right? So delta is your best friend. And now the second most important, if you're swinging, is theta. Theta is that price per day you're gonna pay to hold on to your contract, right? So if you have a super high theta, like you're gonna be getting chunked every single day, even if the stock is holding flat. So you want to make sure to have high delta, low theta. The third and one of the most important is implied volatility. If you can align a high delta, a low theta, and a low implied volatility, you're looking at damn near the perfect contract to be taking. So that's
right. And these numbers. So those are the 3 things we're looking at. Say for a day trader: high delta, low IV, and low theta. Right.
What are the numbers?
What are the numbers?
Okay.
People are gonna be like, well, what the fuck? Okay, well,
the only thing that's relevant. Okay, so those numbers are kind of unique to what stock you're trading, right? So, for example, let's say the contract premium you're taking, costs 30 cents or $30, right? 30 cents times 100. If your contract premium is 30 cents and you have a delta that's at 0.3, that's quite a high delta. Why? Because for every dollar the stock moves up, you're going to be making 100% on your position, right? So delta is the price you're going to be getting paid for every dollar on the stock that it moves up. So let's say your premium is delta 3 and you have a premium is 30 cents and you have a delta 3. That's a high delta, right? You're going to be getting paid $1 for every you're going to be getting paid 30 cents for every dollar the stock moves up, or 100%, right? So when it comes to delta, it's very relevant on the stock. Same thing with theta, right? So again, it's all dependent on what the contract premium itself actually is, right? So obviously you don't want to have a theta that's higher than your contract premium, because you're gonna go expired the next day, and you'll usually see that on like way out the money contracts for something that expires like tomorrow or the next day. You'll see high theta like that, right? But it's not necessarily the number. It's based off what strike you're taking and what expiry you're taking. So a general rule of thumb is further in the money or at the money, the higher delta, the lower theta, and yeah, pretty much it. And the further expiry you take, the lower that delta is. Okay, so you're gonna be getting paid less for the movement, but also that data is gonna be less too, right? So you're not gonna be getting chunked as hard for every day you're holding on to those contracts. The
Right.
only thing that's kind of standard across the board is implied volatility. Implied volatility now, in this type of market that we're trading in, where there is high general volatility. Okay, like I would say maybe 2 years ago, a low implied volatility, in my opinion, would be like under 65-70% would be good implied volatility. Now in this type of market, go look across the board, you're not going to really find anything that's under 60-70%. So in my opinion, I would say anything under 100%, like 90, 80, 70%, that's a generally low implied volatility, right? And you'll find stuff that are lower, but they're going to be a lot further out on the expiry. So try to keep it under 100 is a good rule of thumb. Anything that's over 100, now you're putting more risk on the table when you're taking that position.
To comment on that, since it is subjective, though, to help you figure out, maybe if you're not too familiar with the numbers or equating it with the price of the underlying, so you got your option chain, right? You got your weeklies, next week, tri-week, monthly. All right. You want to compare the data. I'm sorry, the delta, the theta, and the IV up against each other. So if you just strictly looking at weeklies, go look for the one that aligns with the highest.
Good tip.
Yeah,
definitely compare them across the strikes and the expirations for sure, and you'll see which one's low. And then another cool, helpful tip: let's say you're just like suck booty and don't know how to calculate these things. Okay, there are tips. There are literally like websites and tools that you can use that will tell you exactly what you'll get paid or exactly what you'll lose when the stock goes to this certain price, how your option's going to react. Like one I like using, I know Unusual Whales has its own tool too, but there's a website. It's called Options Profit Calculator. You literally go in, you put your stock ticker, you pick the expiration, you pick the strike you want to take, and then you'll click calculate, and it'll tell you by this date, if it reaches this price, you'll be up this percent. Or if by this date it goes down this percent, to this price, you'll be down this percent. It'll tell you exactly straight up.
I know a lot of people are like, okay, well, this is all good info. Where can I go to learn it? I know Low Float Savage actually has a pretty good, they have like option. It's completely free.
Sandy Ravage.
Yeah, Low Float.
Legend, absolute
legend, bro. So there is like an options class. It's all free online. Maybe it's a good point to kind of point people in a direction where if some people are self learners. I need to go read it. And instead of hearing people talk about it, I'm sure we can somehow share that website across some social media platforms here or something.
There's this really cool website called YouTube.
I've heard of that, bro. That's a great one, bro.
No, but the Bullshark offers a mentorship. I do. Other people in here do. That's your choice, and you're choosing whether or not you want to go that way. But YouTube is also a good friend of yours as well. To be honest, and I'm not even trying to sell myself. You'll never see me post anything unless it comes to the end of the month where it's just being offered. But I found YouTube to be very, 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 very hard in understanding options. There's a lot of fucking videos and a lot of people confusing the shit out of me. The best person that I learned how to trade options from, again, I knew technicals and knew how to trade my own discipline, was
I
Bullshark.
fucking love you, man. I appreciate that.
As you guys can see from this option summit, maybe he doesn't explain it clearly here. I'm pretty sure it's very well explained. But if not here, then he can definitely break it down with you in direct messages, because I learned how to trade options from him, and as well as Erica. I just made a tweet showing love to both.
Oh man, I appreciate that. But yeah, again, Rhodes is a fucking fantastic trader. The man already came to me knowing how to trade. I just showed him like a couple sneaky tricks, 7 sneaky tricks to get hard.
Shit, yeah, understanding the options.
Yeah, again, he runs his own room. I run my own room. Again, It's not a recommendation. Do whatever the fuck you want. YouTube has everything in the world. You know, but sometimes it really takes, you know, watching someone else do it and seeing what they're doing to really understand what the fuck is actually going on behind the picture, right? So yeah,
Seeing is believing, bro.
I appreciate that. Really nice words, Rhodes, coming from you, man. Like, I used to fucking watch you back in the day trading small caps, and that's where I got like my trading strategy and started using it on options and, you know, kind of doing my thing, bro. That's how I fucking took 5K to a mil, bro. Like, literally watching you. Yeah,
Hell
bro.
yeah, dude.
Literally watching you, Trog.
Yeah, and that Trog,
Fucking
Trog, he was always in the Scalp Room, or the other channel, right? He was always posting these banger plays, but like, you know,
yeah.
there's so too
Trog's
many people
definitely
in there
seen
to
me
ever
in there a few
recognize
times, bro.
talent. Yeah.
Yeah.
But he's OG, and it's cool though, because that's the wonderful thing about the stock market. Like Bullshark and I have insanely different strategies, even though I was a portion of his learning. Now I'm learning from him, and he has an insanely different strategy than me. Lunar Aces too. He has an insanely different strategy. You guys just have to remember that, like, if there's a million ways to make money in the market, right? It's just whoever you think you're aligned to most, or the strategy is you align to most based off of your personality. Um, that's how you really want to approach a strategy and approach a way to learn.
Facts.
Sick. Well, I'm gonna run, guys.
Yeah,
I
I
gotta
think
go
we'll call
eat
it
and
here.
everything.
It's been a fucking awesome option summit. You know, hopefully we can run it back another time. But yeah, there's been a lot of learning, a lot of cool things talked about. Thanks everyone for coming out. Thanks to the speakers for coming out, putting out your insight. Thanks Rhodes for hosting this with me, my boy, my brother. Fuck.
Love you guys.
Yeah.
Hell yeah, brother.
So yeah,
Have a good night, everyone.
Let's kill it
Thank you.
Y'all
tomorrow.
aren't brothers.
Huh? My brother from another
You're
mother.
not brothers. What are you talking about?
Brother from another mother,
Brother
bro.
from another mother.
Fuck out of here, huh?
No, you my brother too, Trog. Don't stress.
It looks like Gary Palmer, our friend, is going to be on Penny's Going and Raw.
Yeah, that's
So
fucking
check him
sick,
out.
dude.
That guy's funny, dude. I love that
Yeah,
guy.
dude. It's so
He's
funny.
so funny. A good trader
I used to
too.
try to trade options with him on the fucking Momo room, and then like no one would be responding, so it would be me and him DMing each other trading Tesla, fucking like 6 months ago. That's how we became friends.
Yeah, he's got a pretty cool strategy. He's a pretty technical guy
Yeah,
too.
he's cool. But yeah,